Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Fidelity's sector equity business cycle portfolio. Now, the strategy of this is quite simple. That is to exploit the wealth and depth of Fidelity's team of talented research analysts and economists to ultimately time the US business cycle. Now, let's kick off in terms of looking at what this portfolio is comprised of. And we see effectively about 10 funds plus a bit of cash. They are all from Fidelity. And the largest allocation is to a tech fund for Fidelity, 31%, followed by a financials fund with 15%, and then communication services with 13%. Now, some of these are mutual funds and some of them ETFs. And given that these mutual funds tend to be quite expensive, the overall model portfolio fee is 55 basis points, which is not cheap. From a benchmarking perspective, the kind of like auto-suggested benchmark from our side is the S&P 500. And we can see that the current holdings, right, would have outperformed the S&P 500 quite nicely. Now, we already seen that the largest exposure is technology stocks, right? And so that might be the simple explanation that Fidelity is doing what everyone else is doing, the performance chasing. We're overweighting the funds that have done best most recently, which explains why this looks so nice looking back. Now, that's of course not the actual track record, right? Because the portfolio has rebalanced over time and the portfolio composition changed. We can look at that by going to the fact sheet and look at the actual track record. Now here we see the Russell 2000 index, right, as the benchmark that Fidelity has chosen. We can see a 5-year return on a gross basis is 14% versus the benchmark that has only achieved 13.15%. So well, on a first glance, you might have said Fidelity, great job, right? Problem, of course, is that the gross return is before transaction costs, before implementation fees, before advisory fees. And 85 basis points for all of that, right? That's cutting it tight. So very likely this portfolio has underperformed on a net basis. Now, moving back to analyzing this portfolio, let's see in terms of how similar this portfolio is to the S&P 500. And we can look at this from an asset class and markets exposure. It's all equities. It's all US stocks, right? And it's primarily large caps, right? Which is why from our perspective, the S&P 500 is the right benchmark, rather than the Russell 3000. Now, from a sector perspective, we do see there are some significant over and underweights. The underweights are versus consumer staples, versus healthcare, and versus industrials. The overweight is with energy, financials, and technology, right? So Fidelity is betting on technology. If we change the perspective from sectors to factors, we can see the following, that actually there's not very strong like factor exposures over time. So here we can see the betas to popular active factors. Some are slightly positive, but the beta is quite low. The only one that sticks out is the low volatility factor. And here you have a consistently and large negative beta. And we can reconcile that quite easily to the overweight in technology stocks, because technology stocks tend to be volatile, therefore you have a negative beta to the low volatility factor. Having said that, if you look overall on the contribution of equity factors to the risk of the portfolio, it's been very small. And it's primarily the stock market that made up the risk of this portfolio over time. Now, that kind of brings us to our next question is if this portfolio is constructed thoughtfully. And the short answer is no. And that's simply because Fidelity is doing what a lot of asset managers are doing, is they're combining funds that have negative factor exposures. So for example, we can look at the beta to the value factor, and we can see that the communication services, so this would include stocks like a Meta, for example, right, has a negative beta to the value factor. These stocks tend to be expensive. But then if I look at the utilities index, right, which tend to be lower from the valuation perspective, that has a positive beta. But negative and positive, it nets itself off. And you have that everywhere, right? Momentum, for example, right? Positive, negative, negative, positive, negative, positive, positive. And what effectively happens, right, is you're combining hot water and cold water, and it just ends up being lukewarm water, which no one likes. And on a portfolio level, that means that you end up with plain vanilla equity exposure, but at high fees. And well, if you still like the portfolio, but you're wondering, can I reduce the fees of this portfolio because it's 55 basis points, right, which is not cheap? We can have a quick look if we can replace all of these funds in here, right, with funds that are cheaper. And so, for example, we have the Fidelity Select Advisor Consumer Discretionary Fund, which is charging a hefty 69 basis points. And we can ironically replace that with an ETF from Fidelity, Consumer Discretionary, for 8 basis points. And if you want to have a quick look, if that would have been a good trade, let's see how these stack up, right? Oh yeah. So we can see the fund, right, which is expensive, 69 basis points, versus the ETF, right, which is the same exposure, and the cheaper one would have outperformed. Now, if we replace every single fund with a ETF that is cheaper, right, we could have reduced the fees from 55 basis points to 8 basis points. Having said that, to be fair to Fidelity, right, the portfolio has slightly outperformed the optimized portfolio, right? So you could argue that was worth paying fees for. Now, finally, we're going to check if it is worth or possible to simplify the portfolio. As mentioned, there's 11 funds in here, and short answer is yes. So we can reduce this from 11 funds to 2 securities, and the 2 securities would be simple above 50,000 plus a bit of technology, right? Because as we've seen, there's an overweight technology. And that would reduce the cost from 55 basis points to 15 basis points. And that kind of concludes our short analysis of Fidelity sector equity business model. So if we look at the performance of the current holdings, they've done quite nice. But as mentioned, we can simply explain that by that overweight to tech stocks, right? And that's simply a hindsight bias. If you look at the actual track record of that portfolio as per the fact sheet, this portfolio has, underperformed, has likely underperformed on a net basis, right? And we can reduce fees easily if we want to, right, from 55 basis points to 8 basis points, and also simplified if we want to. Hope that helps. Have a nice day.